Greetings, Peter Nelson here with Full Service Property Management. And I want to just discuss 1031 tax-free exchanges with you for just a short bit. I'm not going to get into how they work. There's plenty of information out there on there. I've done one 1031. It was years ago. And I want to explain to you a couple of the advantages and disadvantages of them from my own experience. First of all, a 1031 will allow you, of course, to take the gains from one property and roll them into another property, presumably as a down payment, without having to pay capital gains taxes. That oftentimes, in a 1031, you oftentimes increase the amount of your debt, which isn't necessarily a bad thing, but it can be a bad thing if you lose the property. If you get leveraged to the max and cannot make your payments and you end up losing that second property, then all the 1031s in the world aren't going to help you. So just make sure when you go into a 1031 that new piece of property you're not overextending yourself. I want to share with you just my own personal experience with the one that I've done. It was several years ago, maybe 20 years ago. And, I was younger in my career. I had bought a smaller piece of property, built some capital gains, and rolled them into a larger piece of property. Well, now I'm later in my career. I'm ready to maybe sell that property, and I'm in a higher tax bracket. And the capital gains are a lot bigger. So let me give you an example. Let's say I bought this house 20 years ago or 25 years ago and sold it 20 years ago and rolled it into a 1031, let's just say a couple $100,000 into a 1031. 20 years later, that new property that I had acquired, my equity is now worth $1 million. Well, now I'm in a higher tax bracket, paying higher taxes on a lot more equity. You follow him? So you want to be looking forward, thinking. It wasn't a bad thing because I was able to, like I said, leverage into a bigger piece of property so I could experience those gains. But just be aware that, when it does come time to pay the piper, you're most likely going to be in a higher tax bracket. You may not. You may actually find after you retire, you're in a lower one. But just be ready for that because later in your career, you might be earning more money and in a higher tax bracket. Hope that helps and good luck.